In this video, I'm going to go over 4 charts from Dent showing the stock market and housing bubbles. Then I'm going to look at the labor force participation rates and home ownership rates to show something isn't jiving with housing right now. So stay tuned. Here's a chart of so-called dumb money volume getting into stocks. Judging from this graph, we can only assume that what's driving the stock market is dumb money. One word of caution, however, is this chart looks at small trader option open calls. The assumption is that small traders represent the retail investor and large traders represent the whales. Large traders are considered smart money and retail traders are considered dumb money. The thing to be weary about, though, looking at these type of charts, is that if it is possible for the whales to disguise their bets by making multiple small contracts instead of a few large contracts, in essence, they could mask the fact that they are smart money to trap people looking at this information and take the other side. So if it is actionable to take the opposite side of a retail investor, then surely whales would have an incentive to mask themselves as retail. The next chart is more useful in seeing how we are in a bubble. A Federal Reserve induced bubble for sure. Look at what happened as soon as the illness pricked the bubble. Fed's assets nearly doubled. This is an insane amount of money printing. And it's gone on for such a small period of time. The natural tendency during a downturn is for prices to come down, assets to deflate, and debt to deleverage. So what happens is that we need increasing amounts of debt in order to keep things stable. If it took 3.4 trillion this time around, it may take another 10 trillion the next time, and then more and more. It is a never-ending cycle. This chart looks at money supply growth versus the growth of assets. The money supply growth has been 3.1 times, while assets have grown much larger. Household real estate is up 5.8 times. The stock market capitalization is up 9.2x. The bond market capitalization is up 5.5 times. And total wealth, financial assets, are up 20.5 times. For every $3 being printed to existence, $20 is being created in terms of financial asset wealth. They didn't work for this money. They just had it printed for them. If ever there was a chart that showed the rich getting richer and the poor getting poorer, this was it. The ratio to get back to 1-to-1, financial assets would have to drop by a factor of 7. That means dropping by 85%. And that is exactly what Dent predicts. Here he is in his own words.
But you don't have to risk much because markets are already way overvalued. Real estate stocks, that limits the gains. But again, what does the smart money see? The better the markets do, the bigger the bubble, the more the downside. My projections are 5,000 Dow, 450 S&P 500, and around 1,100 on the NASDAQ. That is an 85 to 89% crash, very similar to 1929 to 32. Real estate going to go down 40% plus in the U.S.
Okay, now on to the housing bubble. Prices of homes are so unaffordable right now because of the Fed that we are now projecting 20 million more people will become permanent renters. The typical life cycle is people will start their lives as renters and then slowly buy homes. They'll have kids, hopefully move up in home, and then downsize as they retire. This chart, however, shows millions more people will be unable to ever own a house, but instead be a permanent renter. There is a bubble in housing and homes are expected to go down in value. Dent projects that cash flow rental properties will continue to be in demand. This chart shows that. There's 2 sides to the housing game, asset appreciation and cash flow, though that doesn't mean to get into the market right now. Staying in cash, selling all your marginal properties, and then buying things up when they become cheap is what he recommends. Dent is incredibly bearish on housing, stocks, even gold. He expects a massive wave of deflation as debts around the world deleverage. The concern I have is the Federal Reserve doesn't appear to want to let this happen. In fact, nobody is holding them responsible. Nobody is telling them to stop with their propping up of assets and bailouts for the rich. They will keep doing it. We've seen their assets grow to 7 trillion. Well, why not 50 trillion? Why not 200 trillion? the politicians are obviously turning a blind eye. So the natural deflationary pressures Dent expects may not come, not until the bubbles are pricked much more massively. Here is a graph of the labor force participation rate since the early 90s. And now just looking at the last bit of it, we can see that the illness has caused this to fall off a cliff. We have fewer than 62% of people participating in the labor force. Now this does not mean that 62% of people are employed. Only that 62% of people are either working or looking for work. When they tell you the unemployment rate, they leave out the other 38% who they say are not participating in the labor force. That said, here's the home ownership rate. Not only is it climbing, it just shot up about 4%. Ordinarily, we would celebrate a higher home ownership rate. We want people to buy homes, but only if they can afford it. Now, the home ownership rate has gone up now at a time when house prices have already peaked. Look at the median sale price of houses in the U.S. It is already at a peak. It is not a healthy market when so many Americans are dropping out of the labor force and buying houses at peaks. I bought a rental property last year in Vegas, and it was incredibly difficult to find a starter home because they were being gobbled up incredibly fast by investors that threw caution to the wind. But now I can see a dozen or so homes in the neighborhood that I bought. The prices are much higher per square foot than they were last year, but are more affordable because they are the smaller ones, the more entry-level homes. This could be what's going on in the country. Investors are pulling out of the market, and the scared public, worried about their financial futures, are rushing to buy houses while they still have provable income.
One thing, every time this bubble goes up a little more, the risk rises. It does not prove that it's sustainable. It's just proving it's more unsustainable. That's the way smart money thinks. Don't get tricked into this, oh, well, it hasn't burst now, and people like Harry and Martin have been wrong so far. That is the wrong way to think here. Look at history. Greater bubble, greater the burst. The farther it goes, the riskier it gets, and then the more it bursts when it does. So do not get consoled, even if this goes another couple more months than I'm saying. I think the stock market bubble is about over, and I think the stock market bubble is going to trigger the real estate bubble, because real estate has been underbuilt since the GFC, and that's why it's more scarce and holding up better. But there's no way when stocks crash and the economy goes down that real estate will not go down with it, and real estate is the most overvalued ever. Real estate does not get overvalued like this very often. No. This is the greatest real estate bubble in history.
The last piece of information I wanted to put together in this video is a global office impact study by Cushman & Wakefield. This is a research company with investors and developers as clients. They are incentivized to give good, actionable advice to their clients. The vacancy rate in 2020 is currently at 14%. By the end of their projection in 2024, it is still not expected to recover. Rents are also not expected to recover by then either. In Asia, Greater China, Canada, vacancy rates are expected to recover, and rents as well, but not for the United States or Europe. Rents are expected to drop 6.5% in 2021 and another 2.3% in 2022. Work from home rates are expected to double globally in the next 10 years, so they project 10%. It's possible they are underestimating this. Companies will see this as an opportunity to save a ton of money on office operating costs and move to a remote workforce. Then it will also be easier for them to hire cheaper labor globally. If rents go down, developments may not be kept up as well as they had been, and going to an office may no longer be as desirable. Perhaps the most sobering of all is the fact that the job losses are expected to continue into 2021. So what happens when you combine a shrinking workforce with a higher likelihood to work from home? Well, a surge in office vacancies. Couple that with retail and hotels that we had seen in an earlier video, and you have commercial real estate deserts. And so here in this chart, we can see that the job losses are expected in 2020 and 2021. This is a graph of Greater China. The job losses are not expected there in 2021 like they are for the United States.